Welcome to Real Estate. It's not that complicated. Broker Ryan Cook and curious co-host Kent Thaler guide you through buying and selling minus the jargon. Here's today's episode. Take it away, guys.
Hey, I'm Ryan.
And I'm Kent, and together we're the Real Estate Navigation Team. Welcome to today's episode of Real Estate. It's not that complicated podcast. Today we're going to discuss
Mortgage lending, a very exciting topic. It is actually very crucial if you want to become a homeowner, whether that be a single family residential, a condo, a multifamily, anything in the residential space is what we're covering today. Very important episode to understand why things are the way they are.
people have a lot of misconceptions about mortgages. They look at them as a weight around their neck.
And I think a lot of people tend to think that the loan officer that you may be dealing with, whatever institution, is an adversary. And actually, they're really part of your financial team.
We purposely brought in somebody today who is able to explain how the mortgage fits into the whole process, which is important. When you think about it, this is one of the largest, if not the largest purchase you're going to make until you buy your next house. And understanding how it's financed from the bank's perspective gives you a heads up as to what you're going to need to do to be able to afford that particular investment.
And we actually discuss a number of interesting stories, wrenches that can be thrown into the works and how to get around them, and some processes. And maybe folks don't like to talk about process. We go from them pretty quickly, but it's vital to understand what some of those processes are so you can actually make the process go along much more quickly.
Yes. Little things like understanding what credit is.
That you can't actually use cash doesn't mean show up with bags of cash.
Correct. People make the mistake of changing documents or financial commitments that they have during the purchase process, which in turn throws their ability to get the mortgage off.
And they see someone's advertising a lower rate and they think it's just easy to swap over.
And they don't understand what goes into getting a mortgage.
Or the liability they may be creating for themselves.
Yes. And hopefully this podcast makes it a little less complicated.
All right. So why don't we get into it at this point? Today's guest is
Ron Schwartz.
Ron Schwartz with Embrace Home Loans.
Yeah, he's a senior mortgage loan officer. He's been doing this for 20 plus years.
And he's down in the DMV, the DC, Maryland, Virginia area. So he's out of our area. We're reaching out to other people because things do actually happen outside the New England region.
Don't tell anybody.
Yeah, don't tell. I lived in California for 5 years. I know stuff goes on outside of here.
Yeah, see, I may have lived in other places also, but I'm not willing to acknowledge that stuff happens anywhere else other than in my immediate world, because in the end, it's all about me.
It is all about you. Okay, so let's get into today's episode.
Today, we have with us Ron J. Schwartz, Senior Mortgage Loan Officer, NMLS number 47148, licensed in Washington, D.C., Maryland, and Virginia. With
Florida.
us today. Oh, and Florida. It's not in your SIG file, Ron.
Thought I'd throw that in there in case my mom's listening.
Who is going to talk to us today about the exciting world of mortgages. Ron has been a licensed mortgage officer since 2002 and has worked in mortgage brokerages as well as large banking institutions and privately held mortgage companies like the one he currently works in, which is Embrace Home Loans. Ron has been recognized as one of the top 100 mortgage originators in the United States and is presently licensed, as I said, Maryland, DC, Virginia, and Florida. His varied business experiences include several years of information technology and software solution sales, as well as 7 years in commercial property and casualty insurance. Ron is also a native of Warwick, Rhode Island.
That is correct.
How cool is that?
It's not. It's really not.
It's Go Tollgate Titans.
Anyways, welcome to the podcast. Excuse me, Real Estate, It's Not That Complicated podcast. Ryan and I are really excited to talk to you, Ronnie, because not only do you bring the mortgage experience to us, you also bring a perspective that is not Rhode Island and Massachusetts centered. In real estate, it's very clear that different regions look at things and trends very differently. And we're not necessarily saying that we're aware of what even all of them are at this point in time, but we acknowledge that they're there. And we don't want to be boxed in and have our listeners feel that everything that we're doing is only for New England, because a lot of our experiences can be translated and shared across the country. So we're really excited to have you today to talk to us about the mortgage experience.
Thanks guys, for this opportunity. It's great to be here and be able to give you some perspective on a more national basis.
Okay. So to that end, Ron, so that we can get started, tell us a little about how you got into the mortgage business.
It's an interesting story to basically no one.
That's the way to start a
Right
podcast.
around
Hope I'm
September
in.
11th, 2001, the world changed. I was active in selling software solutions to Fortune 100 companies and government agencies. Obviously, September 11th changed the priority of those organizations. And I found myself as the only non-billable guy at a software and solutions company, and soon found myself between careers. A buddy in the neighborhood said, why don't you come and send out your resumes from our little office full of desks where we have guys who are doing mortgages for local families. And then within a month of that, I was one of their top mortgage originators. I found that working with families had a lot smaller decision criteria for the decision makers than we would at a big corporation like Daimler Chrysler at the time. We would sell our solution to a committee of 25 people. And by the time they made a decision, 10 of them had already left and gone to another position. So when you work in the mortgage business, to me, the greatest part about it is the math of the situation tells the customer whether or not what you're proposing is valuable. If the math works, it makes sense. If it doesn't, you can still be friends with the consumer and they can send you to their neighbors to see if the math works for their neighbors or their friends. To me, this was the greatest opportunity, and I became a more transactional professional than I had previously. And like I said, I've been here for the longest part of my career. I worked here a long time at a big bank that used to be called SunTrust. For many years, I was in their chairman's team, and I happen to love when I can help a family, particularly first-time home buyers or immigrant families, purchase their first piece of the United States. That's how it happened.
That's an interesting path that you took to get there, but not one that is uncommon in your industry. I don't remember any kids running around in the neighborhood saying, I want to be a fireman. I want to be a policeman. I want to be a mortgage. I want to be a mortgage officer.
Kent and I also grew up working together in a ski and sporting goods store at Warwick, and none of us were like, hey, I'm going to be a great mortgage guy.
Yeah, that never happens.
I wasn't going to be a professional skier. I can attest to that.
You were not going to be a professional skier. That is true.
I might have been pretty, but I was slow.
I would argue about the pretty part.
It's crushing your dreams.
No, Ron could sell skis incredibly well. There's an old adage, those that do, those that don't sell. Oh, I'm sorry. Those that don't teach. Yeah. In any event, I'd like to get, now that you're in the business, explain to us what a mortgage really is. And is it just a fancy loan with a house attached to it? Or is there more to it than that? And how does it differentiate itself that it needs its own word from a fancy loan with a house attached to it?
It's a really good question. Particularly when I work with families of first-time homebuyers, it's this sort of mysterious thing that everybody does because they want to own a home. Let's break it down a little. A mortgage is basically a promise. The consumer promises that they will pay back the loan that they took out on the house they want to buy over a 30-year period. That promise is very often referred to as the mortgage note. It's the agreement with the homeowner and the lender. The homeowner will make payments, make them on time, and continue to make them through the term of the loan in exchange for the right to borrow that money to buy the house over that term. It is different than most other types of loans, mainly because of the collateral. So the collateral is a piece of real estate, be it a lot, a trailer, but usually it's a condominium, a single family home, or a townhouse tied to a piece of land. And that mortgage note is also different because it is recorded at the recorder of deeds in the jurisdiction where the ownership of property is recorded and guaranteed to the homeowner.
Okay. So
There are a lot of laws. Go
Okay.
ahead. So yes, it is looked at differently also in terms of the consumer's credit, because the risks associated with owning a home are different than owning a car or a couch or a TV.
Okay.
Certainly the loans are larger, but someone who invests in a home is less likely in most cases to go bad on that debt because that's the roof over their head. So there's a lot to it. There are a lot of things that we do to make our mortgage underwriters feel comfortable that the consumer is going to be likely to pay back the loan. And as we get into this more, I'll explain those factors that make us more likely to be approved for a loan versus those that will make it unlikely for us to be approved for a mortgage.
So I want to stop you and I want to go back and focus on one specific point that you just made that I think is incredibly important. And that's the fact that the mortgage is recorded as a deed. So Ronnie, I want to go back a second and focus on something that you mentioned that I think is really important as a differentiator between a mortgage and a actual or a regular loan. And that is that the deed or the mortgage is recorded legally as part of it, as the part of the deed process. So a lot of people probably don't understand what that means and how that affects them going forward in their ability to sell or improve upon that piece of real estate that they just purchased a mortgage for.
A lot of people think when they get a mortgage, they're actually buying a house. They're really not. They're buying a piece of paper that describes a piece of land that the structure happens to be on, or if it's just raw land, it's just the land. They're not actually buying a house. They're buying a piece of paper that gives them the legal right that says they're the owner of that piece of land and what's on it and below the ground.
And that right includes the typical language is the right to use and enjoy that piece of property that the legal term is chattel throughout the term of their ownership. What happens actually in most states, there's a thing called a mortgage note that gets recorded, but in many states, there is a thing called a deed of trust, which refers to the promise. And some states record the mortgage note. Some states record the deed of trust that says there is a mortgage note between Joe, the buyer of the home, and the lender from which he borrowed the money. The terms of the agreement between a buyer, the borrower, and the lender are in the note. And that is why some states only record the deed of trust, which describes the property and the parties to which the deed business was done. Okay. So it is a big deal that when you provide payment to the seller of the property, again, in legal terms, they call that payment consideration. And in the old days, that consideration might not just be money. It might be a number of chickens and goats or whatever of value you are exchanging with the seller of the property to receive the value of the right to enjoy and use that property throughout your period of ownership. That's essentially what those agreements between buyers and sellers and the description of the property that is contained within that agreement, that piece of paper, is what gets recorded at the courthouse.
Okay. So now that you've put me to sleep.
Sorry.
And I appreciate
an exciting business.
It is an exciting business. I guess that you've focused on and answered the question of what's actually going on and what's happening so that people get back to where Ryan's point, which is people misunderstand what a mortgage is. Right. And understanding that it's basically you're buying the land and it's giving you permission to then, because you now own the land, you now have the right to enhance your land. And then you put the land up as collateral against the house that you're going to build on the land. So in theory, you could take a mortgage out on your land, you could build a house on your land, and then you could take that house and you could move it someplace else. The land is the piece that stays permanent because it doesn't move.
Well, that might seem logical. However, the terms contained within the mortgage note would prevent you from devaluing the property without the lender knowing. It's very important. A lot of people don't actually read it. They just go to the closing meeting, sign the papers, and they go off and sip champagne and celebrate and carry their spouse over the threshold. But there are a lot of things that you cannot do to that property unless you're willing to violate terms of your agreement with your lender. Generally, those things which make the property that you're using as collateral less valuable would be very disappointing to me as a lender. If you had $1 million house on a property and just decided you would rather have just the raw land, we would probably call the note, meaning make that note due, pay up. Very important to understand that your agreement with the lender includes things you really can't do like that. Or if you're borrowing a primary residence, you're not allowed under the standard note throughout the United States. You're not allowed to build a bond factory or a gas station or change the use of the property without notifying your lender. Let's talk about that though. Why does the lender care? Because they have an interest in your property. They are your partner.
They have a fiduciary interest in that property. They don't really care what you're doing. They're only concerned about their investment.
There's actually a little bit more than that. Your statement about they don't really care is really inaccurate. And the reason being is they don't care on a specific one-to-one basis because there are other authorities. If you want to add onto your house, you got to go through a building department or a planning department or a zoning board to be able to get the approvals that are still keeping their interest protected. There are other authorities in between, especially with single-family or multifamily homes, not condos. They care because their money is on the line and they want to make sure that you're not doing something to devalue. Just like in your mortgage, it says you have to carry insurance. If you get a note from your insurance provider, they're dropping coverage, a letter goes to the servicer as well, because they're like, hey, wait a second, you got to have insurance.
If our collateral, by the way, is not insured, we will place insurance upon you, which protects the lender's interest in the property, but it's not going to help you if your house burns down and you lose your couch. That placed insurance doesn't cover your interest in the house, just the lender's interest. We'll get into that.
Yeah, okay. I got it. It's a legal document. It's different than my car loan because my car loan is not registered. It's a different process. So how does it get started? How do you originate? I guess what actually happens when you're getting the mortgage? What's the process? People talk about pre-approval versus pre-qualified. Now, how does that whole thing work and what does it mean? And then we'll get into what happens once the purchase and sale happens. We actually have to get the actual mortgage in place.
A great question. I'll tell you, there's a lot of mystery around the terminology in our real estate practices these days. A pre-qualification, a pre-approval, a fully underwritten pre-approval. Let me explain these things. First of all, most of the consumers that I work with come to me on referral, either from their real estate agent or their CPA. They hear about me through things like this podcast or my reputation in the local market. But I actually am on lists of preferred or approved lenders from local government agencies, specific types of housing. They inevitably don't know a lot about the process. So the first thing we do is meet with the customer. I prefer to meet with people in person here at my office and look them in the eye and educate them, just like we're talking about today, about the process and what we're doing and why we are asking them to do certain things. Let me go back one step and say pre-qualification versus a pre-approval. These are degrees of work done by the lender to properly vet and determine the qualifications of the consumer who is asking us to lend them the money. Most real estate agents, when they see a letter that says pre-qualification, which tends to be the lowest form of diligence by the loan officer these days, because of our technology and our knowledge of what it takes to get a loan done as an industry, I'm speaking about not only the mortgage folks, but our partners in the real estate business, a pre-qualification letter is not really worth the paper it's written on. Essentially, a pre-qualified borrower is somebody who may have had a conversation with me and I may have put a mirror under their nose and I've determined that they are capable of putting a fog on that mirror. And that's about all I know about. I may or may not have looked at their credit. I don't know anything else about them other than their name, phone number, and email.
It isn't an industry standard, because I've had some lenders in the area I'm in that they would say they're pre-qual. They've already been through underwriting, and we pulled their credit and verified their W-2s, et cetera. So there isn't necessarily an industry standard on it. The challenge is when you have a lender that isn't following, say, the norms. Realtors or licensed agents out there in the field, when we have a listing, we get offers. We want to see a pre-approval. We don't want a pre-qual, because we look at it and go, we have no idea. This is like stated income. I have no idea if this person can actually afford the house.
I really appreciate it is semantics within our business. There's no legal standard for a letter that I give that says I've looked at what this borrower can do. In my lexicon and the terminology I use, I have 3 levels of diligence. The next level after pre-qualification, which for the most part, I don't even use because my realtors touch it. I'll explain what that means. Pre-approval means the borrower, for example, when I put a letter, in my case, any kind, out to help a borrower try to purchase property, I require that borrower to not only meet with me, but provide me with 100% of the documentation I need to support the information that I will present to an underwriter. That includes things like income history, just done with pay stubs, W-2s, tax returns. Assets, meaning how much money has this person or family saved? What do they have in their 401k? Are they going to be receiving help from a relative or down payment assistance from a government authority? And of course, the C word, credit. I want to know if in the past, this consumer has a history of wisely using credit and paying off their bills and paying them on time. That's usually shown on a credit report. So the level of diligence is what we as professionals are trying to display on a pre-approval letter. Most of us these days also go one step further. If the consumer will allow us a little extra time, which I demand, I'll take all of that and actually have an underwriter review my work, fully underwrite the file.
Quick, before you get too far, we know, at least you and I know what an underwriter is. Most people, an underwriter is like the wizard behind the curtain.
Attention to the underwriter behind the curtain.
People have no idea what an underwriter is, what an underwriting process is. Can you just touch really quickly on what an underwriter is and what role that? One, it's an individual. For people who don't know what that individual's role.
Absolutely. A lot of people think that a loan officer is a person who makes the loan. The loan officer, like me, is a professional salesperson. Only we sell the consumer that we know how to make an underwriter make a decision. The underwriter is actually the person delegated by the investor in your loan to decide whether or not the loan will be made. Person is a decision maker. So my job has 2 sides. It has the side where I collect all the data and sell myself to the consumer as a loan officer. And then it has the side where I present the consumer's information to the decision maker, in this case known as an underwriter, which is a colleague of mine that reviews the file of information and makes a determination based on certain standards as to whether or not that loan would be acceptable for us to. What is underwriter? It's like a big mysterious person. Oh, it's a lovely person sitting in an office, a colleague of mine who I can have a conversation with and say, look, here are the things, here are the reasons that Mr. and Mrs. Jones should be able to borrow $500,000 in order to help them purchase this property. Underwriter is nothing more than a decision maker. These days, a lot of the underwriting criteria are done through a system that's been around for a long time.
Underwriting.
Before AI. And the underwriter basically fills out a bunch of check boxes, but also there is a degree of common sense involved in the underwriting process. They get done and they hand me a document that says, we will commit to lending the money to this consumer.
So the third level that you're saying is, what do you call that? So is that pre-approval? Is that approval? Is that
semantics? At our company, we call that approve to move, but that's a marketing term. Right. So mostly when I speak with my realtors, let's say Ryan is the listing agent on a property and my customer and their real estate agent proposed they would like to buy the property that Ryan's customer is selling. I will call Ryan and say, Ryan, Mr. Biff, take my call. I want you to know that Mr. and Mrs. Jones here have not just been pre-qualified. They've not just been pre-approved by me. I've actually taken their information, completed a file, had an underwriter here review it. And what you're seeing is an actual commitment from the underwriter. The thing that's missing is the property that fills in the blank of subject property on the proposed contract. So there's a spectrum of diligence is what I call it, that a loan officer should be doing. In my opinion, because the property, once it goes under contract, is no longer on the market, it really is an important process because that seller may have another property to buy, but every day their property is not on the market is potentially a liability for them.
Yeah, and we can pull in a little bit of our conversation recently with Lori Seavey, who's on the listing side, if you remember our conversation there.
I do.
And where Lori, when she's got a number of offers, is validating, calling the lenders, checking, trying to make sure that what was written in the offer, they want to see how strong it is. And I will tell you right now, when it's a tight inventory market, it's the little things that help. Sure, the dollars help, as you like to say, Ken. I just want to know how big the wheelbarrow of cash is that's being wheeled up to my house and how many zeros are after it.
Yep.
Absolutely. But you want to make sure that if they're making a promise of lots of zeros, they can actually move forward. And so that's where you get the pre-qual, which is very low level that most agents, we're not going to accept an offer with a pre-qual, a pre-approval. And then every different lender has a different term for a pre-approval. It's actually been through underwriting. We joke around and say, oh, it's a super duper pre-approval, but yes. And I don't know who started it. I remember probably a decade ago, Quicken Loans had started doing something similar to that to try and make, and not saying one lender is good and one lender is bad. It's just, I think it was about a decade ago or so that we started seeing Quicken Loans start to do something. And when a marketing idea takes off and someone sees another lender getting market share, that the biggest compliment is to copy what someone else is doing if it's effective, and obviously if it's legal. And it's certainly very legal. And
it's not only legal,
it's prudent.
It's 100%. In a market like ours, frankly, there's a reason I have a federal license to do this job. And it's because when I say I have done something, I have done it. If I say that I've reviewed somebody's credit and I haven't, I'm committing fraud. And that is a potential litigious opportunity for someone who finds out that I didn't do what I said I did. That diligence, the standard of my profession. So call it what you will, pre-approval, or I literally just break it down like we are today and say, this is a fully underwritten loan file. Here, and I can actually put it in writing, and an underwriter's name is attached on that. It says, as long as the financial features of the property fit the approval criteria, meaning the borrower can borrow this much, then the house fits in the box that the letter describes, and the loan can proceed subject to whatever the terms of the contract.
So only because I like to talk in more specifics. Explain to me a little bit about credit and what goes into and what you look for and documentation, what you really need to be able to get somebody I'm going to use the word qualified with a lowercase q, qualified for a mortgage. I know that there are 3 credit reporting agencies. Is there one that you use over a different one? What happens if there's discrepancies? How do you guys determine that somebody's credit is accurate, both on the positive side, oh, we're going to write this loan, and on the negative side, oh, they're at 651 and we don't write loans unless it's 652.
There's a lot. It's a huge, we could do a whole podcast just on credit, but I'll give you the basics, which is what you're asking me for. There are 3 credit agencies we use in the mortgage business. Those are TransUnion, Equifax, and Experian. We look at all 3 reports simultaneously in one document. We call it I merged credit report, meaning all 3 bureaus report on one document.
Yep.
Hey, great. Kent, real quick quiz. Which score do you think they take? Do you think they take the highest score or did they take the lowest score?
Oh, the lowest.
Well, that's not the case. We actually take the middle score. So it was a trick question. We don't average the scores. We don't.
I felt like I just got 3-card Monty'd.
It's very much like 3-card credit Monty. So and if there are 2 borrowers, we take the lowest of the 2 middle scores. Those are the basis for the loan underwriting criteria, and also the basis in some cases for the rate, and we call the pricing of the loan. Obviously, someone who has A lower credit score can represent a higher risk to the lender, and they have loan level pricing, meaning down on the loan level, someone who has a 620 score is a higher risk than someone with a perfect, maybe an 800 or 800 plus scores. The range in credit scores goes from 400 to 850. Generally, consumers should fall somewhere between 740. Let's just say 640 and above is fine. There's always a loan there. And as you get below 640, you start to have challenges, and we have loan programs that help consumers that have lower credit scores. But I'll let you ask questions about that.
So when somebody comes and says, I'm worried about my credit because I'm a new buyer and I just graduated from college and I've got a job, I never bought anything big. How do you evaluate that credit versus somebody who says, I'm 50 years old, I've been in the same job for 30 years, and I ran into some problems a couple of years ago, but they're all resolved now. And
we'll fix the question to start with. It's not someone fresh out of college. At least have them working for at least 2 years, and then
2 years. Somebody who's been out of school and has her MBA, for example, and has been out of her graduate program for now 3 years.
First of all, the college education is not a requirement for a mortgage loan.
Okay.
And anyone over the age of 18, it is eligible to apply for a mortgage loan and hope they wouldn't be rejected for their age. There is no age criteria. Someone who's 97 years old is still entitled to apply for and be approved for a 30-year mortgage note, believe it or not. So age is less of a factor. Credit history is displayed on a credit report, whether the person has established credit, if there's sufficient credit for a score to be generated, is the key criteria in mortgage credit analysis. So you may have someone who is a sophomore in college or an 18-year-old who just graduated high school and had maybe already had a couple of credit cards and has great credit and left high school and got a great job and now wants to buy their first home. All of those persons are eligible to be reviewed. If the credit report shows me that there is any credit history and a strong enough score to meet the lending criteria, I'm happy to offer them the opportunity to purchase a home. Some of the first-time home buyers also get what's known as a cosigner. So maybe that 18-year-old has their dad, mom, or a relative cosign to back them up with the underwriter and offer additional stability and likelihood that the loan will be paid.
And the cosigner, I'm assuming, is also financially liable for the loan.
That's correct. The cosigner would be essentially like a backer.
Yep.
Look, not only is this person qualified, but I'm guaranteed I'm standing up behind them and saying they're a good kid, and I'm going to help them out if they need to change jobs. They're a little short this month. I'm going to help them make the mortgage.
I want to ask real quick, does a cosigner need to be a family member, or can it be any consenting adult?
It does not need to be a family member. It can be any consenting adult, and some programs vary in that area, but for the most part, it's anyone who is creditworthy, and it's got to make sense to the underwriter.
Is there types of credit that are better than others when looking at, for example, is paying a car loan religiously better than, say, a credit card loan?
Let's talk about a car loan and a student loan and many other types. For example, people buy furniture on credit. Usually these are called installment debt. And the regular payment and timely payment of installment debt is a good thing when it comes to establishing credit history. Revolving credit, most commonly known as credit cards or charge cards in the past, is also a good thing as long as the consumer uses credit wisely. Using it wisely in the eyes of the people who make up credit scores, usually some actuary in some deep, dark basement at a lending institution or government agency. But these folks analyze risk based on the consumer's establishment and use of credit over time. So someone that borrows $10,000 on a $10,000 credit card and drives the balance up and then never pays it off is probably not likely to be a good borrower of $300,000 against a house. Conversely, if someone who has a car loan and it's $20,000 and they made every single payment over 60 months on time, and then they have a couple of credit cards that they borrow, go do their grocery shopping or go on vacation, and they pay it off in a timely fashion, that credit history will show that person wisely uses consumer credit and is likely, in the opinion of these actuaries, the foundation of credit score, is that person is more likely to be a good risk, a low risk to a lender. So
You actually bring up a really good point I want to bring up when it comes to analyzing what's good credit risk, bad credit risk, people paying bills. Has there been any changes proposed or credit scoring or changes adopted by lenders? Because what we've seen over the last, as long as I've been in the business, say certain folks who the family doesn't have a history of owning anything, but they've had apartments, they've been paying their rent regularly, they've been paying the utility bills, but those generally haven't been included in credit scoring. Have we seen any changes to those where folks who are trying to become first-time owners and have been making those types of payments, but maybe don't have credit cards, or they never had a car payment because they paid cash, finding a way to, I guess, analyze and verify someone like that they are a good credit risk?
There is a whole segment of my work where we do what's called establishing non-traditional credit. So the consumer who is maybe just old school and just likes to do everything in cash and never wanted a credit card, maybe they're averse when it comes to, they don't want to be in debt to anybody ever. We have the ability to look at their utility bill payments. We can look at their rental history. We can look at other aspects of their credit, primarily those utility bills and rental history, and establish a credit score. Very often when I work with consumers that build their credit and there's literally no score because they have no history of using credit, it takes some time, but we can pursue what they call non-traditional credit and look into how we can help them to establish a credit score. It's not something that happens overnight. It sometimes takes several, maybe 6 to 12 months to establish non-traditional credit. Sometimes it can be done a little quicker. But yes, those consumers are not barred from access to credit in the mortgage sector.
Is a consumer penalized for paying off a loan faster than it needs to be paid off? For example, if somebody were to finance a car and they were able to pay it off in, say, 2 years instead of the 4 years of the term of the loan, right? They would then have 2 years where they don't have a payment, but they own the car. Does that penalize them in the eyes of the credit reporting agencies?
No, it actually would indicate a wise utilization of credit. And while the lender, when you paid off that car early, the lender didn't get the interest that they hoped to get over the full term of the loan, they can't fault you for not wanting to pay all that interest. So paying off an installment loan ahead of time is actually a wise utilization of your ability to use credit. So it should not penalize you.
Because
it can, but it shouldn't. There's a lot of delicate balance between utilization of credit and not. But if you don't want to pay the interest, you borrowed $20 to pay it off in 2 years, you should be looked at as.
I agree totally. And when you pay off a car loan, depending on how high your credit score is, your credit score drops. And that's why one of the things, like when I'm talking to clients, early in my career, you didn't know, I try and give my clients advice, but before they do anything on payments, whether it be paying off a credit card, paying off a car loan, taking on any other debt, I'm like, before you do anything, talk to the lender, because we want to make sure you think you're doing something good and you actually make your credit score go down. So we want to make sure, talk to the lender, get approval.
I will say this. The biggest mistake consumers make, particularly with revolving, with credit cards, is paying them off in closing. The reason that impacts the score negatively is that when you're scoring somebody, you have to base that score on open and available credit, meaning if you got a $10,000 credit card, you did something and you borrowed $5,000 on it, and then you paid it off, and then you turned around and closed the card, there will be no history anymore. There's no history of when the account's closed. Yeah, the history says in the time the card was open, it worked out really good for the lender and for the consumer. But now there is no open trade line for us to analyze. Similarly, if you feel that an installment debt the closure of an installment debt has reduced the credit score, it's because that's no longer an open trade line. It's not because the consumer's behavior was bad or good. It's just that there's less credit for the analysts to analyze, and therefore it has a harder impact. If you have 5 credit cards, all of which have zero balance on them, you're much better in much better place. You have much available credit and you're very low risk because you haven't used all of it. On the other hand, if you had 5 credit cards for $10,000 each and every single one of them is maxed out and you're only making the minimum payment for several years, it doesn't bode well for the analysts to say that lending you more money is a good idea. That's generally the trend. There are smoke and mirrors underneath the credit world that even I, after 25 years of doing this, I don't understand some of the logic and reason, but generally a consumer's goal to improve their credit score could be impacted. Great strategies are try to keep, for example, if you have a $10,000 credit card, try to keep that balance below 50% of the available credit and you tend to have higher scores. Always pay at least the minimum on time. Paying things on time is the most important part of credit scoring on revolving credit. If you miss a payment, it's going to have a real negative impact on your score.
So I guess where I'm going with this is, do you as a mortgage or a loan originator, do you have the ability to look at somebody and say, okay, she had this loan or he had this loan on a car and they paid it off. The credit score went down, but I saw that they paid it off. They have 2 open credit cards and they are keeping the balances low. Do you have the ability to say, although Experian has that rated at 710, I really think that's closer to a 740 behavior? Or
Well, let me say,
that's the question.
I really like the way you put it, because even when Ryan said, hey, I had a consumer who paid off an installment loan and their score fell.
Yeah.
Remember, their score fell from 740, which is excellent, to a 710. It's still excellent.
But if it went from 710 to 680, that might be enough to get them from an A loan to a B loan. It might be enough to change the interest rate.
680 might be Tuesday, and the following month on the same Tuesday, he might be back up to 710. These are short-term impacts for most consumers. The things that really move the credit score dramatically are payment history, meaning your payments on time, judgments, collections, bankruptcy. Also, remember, paying child support late is something that can impact your credit score. It's really what we call adverse credit. That is the thing that consumers should be most diligent about. It's really important to understand that, yes, the movements, these small movements where you pay off a debt and you have fewer trade lines. For example, let's say you had 3 credit cards and you closed 2 of them after paying them off, and then you went 30 days late on the 1 credit card you had left. Well, it's going to have a much higher impact on your score because you're going bad on the small amount of available credit that you have left. The movement of credit scores within 10, 20 points for consumers can happen day to day. I don't actually know every minute, every section of why that happens. Maybe we can work with a credit expert on that going forward. But the truth is, if your score is pretty good today and you pay off a car, it'll still be pretty good tomorrow in terms of mortgage.
Okay. So
Viewed out. I don't play the game of, for example, some people say, I had a 780. What can I do to go over 800? My advice to any consumer is don't play with it.
gotcha.
Keep doing what you're doing. If you're excellent today, you don't have to be more excellent tomorrow. The truth is, like being pregnant, you're either excellent or you're not excellent. It's simple. You're going to have anywhere over, say, a 720, you're going to have a great loan, and the movement of the loan, the pricing changes on your loan interest rate is not that dramatic.
Got it. So we've got all of our data. We have our approval. We have our guidelines or criteria for being approved. We found a piece of real estate. We make an offer. What type of loans are available? Meaning, what's the difference? You hear about things like Freddie Mae and
Freddie Mae, Fannie Mac.
Yeah, exactly. Freddie Mac and Fannie Mae. You hear about FHA. You hear about a bank loan versus a credit union loan versus a community bank loan versus a federal back loan versus private lenders who aren't banks at all. What does it mean? Why do I want to be involved with any of those things? How does it work?
And how do you pick which one works? How do you
Right.
know which one is the right one?
That's the greatest question of the day so far. It is very confusing. There's all this terminology. This type of loan, will I get an FHA if I'm a first-time home buyer? Don't worry about it. Your loan officer is compensated to help you find the loan that suits you the best. Okay, so whether it's a government-backed loan or a conventional, and I'll explain the differences, sit down and relax, meet with your loan officer, and discuss the most important things, which are how much cash do I have to contribute to a transaction, and what are my monthly obligations or payments going to be? Let's get into that a little bit more. What government-backed loans? In the United States, there are really three types of government loans. Those loans are FHA, which is the Federal Housing Administration, which gives the lender a guarantee against, it's an insurance policy for the lender against foreclosure. VA, which is a great loan, it's specialized for those who have served in our armed forces, are active or retired military, and have been honorably discharged, for example. And then there's USDA, which is the United States Department of Agriculture, also has a guaranteed home loan program for more rural areas in the country. And you'd be surprised what the definition of rural area is. When you speak with your loan officer, you can give them the address of the property you're looking at.
I wouldn't be surprised because two of my neighbors have USDA loans.
We just talked about government-backed and conventional in our terms.
Well, let's talk about for a minute. Let's define Freddie Mae and Fannie Mac. Freddie
Mac and Fannie Mae they are investors in what they call mortgage-backed securities. When we, as a lender, make a loan, they write the guidelines that tell us if the loan is going to fall within these guidelines. Fannie Mae and Freddie Mac, these quasi-government institutions, will fund and warrant the loan for us, meaning they'll give us back our money that we lent out. They create the credit market for 90%, in my opinion, maybe 80% of the.
I've seen numbers as high.
It's higher.
I've seen numbers as high as 95%.
And that's because most consumers borrow in that category. They're either borrowing in the government backed or they're borrowing in the Fannie Mae, Freddie Mac consumer, we call conventional loan scenarios.
Okay, so what's the difference between the two organizations or the two loan things? Is there a difference?
Not really. As far as the consumer is concerned, they have minor differences in the way they provide guidelines. They're certainly independent financial institutions, but most lenders like ourselves will just underwrite to those two guidelines simultaneously, and someone deeper in the organization decides who is going to be the investor behind that loan. It's all done in the back room. It's above my station in the organization.
So what you're saying
is
the
same thing for a consumer. They are a guideline creating organization who sets the standard for what loans they will invest in, and therefore our underwriters. Earlier I said there was like a checklist. Underwriters said, bang, this loan meets the lending criteria. That's what those organizations.
So what's really going on, and for what our listeners need to understand, is that Embrace Home Loan probably is not putting its money up for my loan. It's going to
get its money back very quickly.
That's the point. But that's the point. As long as it meets the criteria for Freddie and Fannie, then it knows that its money is only going to be at play for, say, 30 days versus 20, 30 years.
That's correct.
And that's when you get the letter that says your loan has been sold to a new institution. No,
it's not exactly the same thing. Okay, so where you're crossing over is the difference between the servicer of your loan and the guarantor of your loan. The servicer of the loan, when you get a 30-year fixed and it starts today, as my company here at Embrace Home Loans, we will eventually, in most cases, sell that loan. That loan is an asset. We'll bundle it with other loans, package them, and sell them to a servicer. Okay? The guarantor of the loan is strictly where we get our money. We lend our money and we get it replenished by the guarantor, Fannie Mae, Freddie Mac, or the government agency, whatever it is. If your loan is with me today and tomorrow it's going to go to U.S. Bank for servicing, U.S. Bank has purchased that loan as an asset with a bunch of other loans from us, and U.S. Bank will be servicing that note. You'll be paying them directly instead of paying my company. So it is a little bit confusing, but I will say this. You should expect the mortgage servicing will be transferred from time to time from US Bank to Wells Fargo, but the terms of mortgage loans cannot change unless you change them, meaning you sell the home, pay off the loan, or you refinance the loan into a better deal for you, and then you'll start again with a new institution. Does that? Okay.
Yeah, that helps. So now that I understand how the loan originates and who's loaning me the money, right? The next question that I would have is, how do you guys determine what the rates are, what fees you're going to put into that mortgage in order for it to close? Like,
That's
are you
complicated, but not
Well,
that complicated. Okay. I like to explain this to the consumer and say, look, the mortgage rate, very much like a stock or a bond, actually it's bond based. It has to do with what the status of the market is at any point in time. So today, for example, let's say that a 30-year fixed rate mortgage on $300,000 is 6.5%. As the loan officer, I'm getting that interest rate published by my organization based on another part of my organization, which analyzes the market and tells me where the market is and what the cost of the loan is to our company. It's like buying potatoes, a commodity. We actually have a big trading desk called the secondary marketing desk that publishes our interest rates day in and day out. Sometimes that interest rate will change even intraday.
No. When I say when I'm using the word establish, I mean, when you say to me the rate is 6.5%, right? That's the rate at that moment? Does that mean that's the rate we're going to close on the next 30 days? Are you guaranteeing me that rate?
Yeah.
And then what's included in that closing rate? Do you guys require anything? And how does it work so that I can actually buy this house?
All right. So when I say that the interest rate is 6.5% to you, just in conversation, that does mean at that moment in time. So it's at 11 o'clock this morning. My interest rates have just been published. At 2 p.m., that interest rate may change based on the movement of the market. Our mortgage-backed securities desk, like a trading desk at a stock company.
What does it take to lock in that rate?
So let's say it's 11:30, the rates haven't changed. You look at a document, hopefully, a piece of paper that shows you that interest rate and the fees associated with it. And those fees, actually, a lender should be showing you both their fees and they call an APR, an annual percentage rate, is a function of the rate plus all of those fees. It creates a slight, in the case of a 30-year fixed rate mortgage, a 6.5% interest rate will usually have a slightly higher APR, which we'll get into, not in too much detail. But an APR tells you how much the fees are above the rates. The goal of an APR is so that consumers can compare a 6.5% offer from me at Embrace All Loans to the same 6.5% offer from Wells Fargo. One of us may have higher fees associated with the rate, and that's something that's really important for consumers to watch out for. That is why all of us at any loan officer really should be not only talking about the rate and the APR, but showing the consumer. These days, we can show the consumer either through a web-based demonstration. Ideally, we'll show them through a PDF that we send them. Or if they're here at the desk, I can show them two different offers and compare the offers based on what the fees are to get to that rate. Fees, by the way, from a lender are often calculated, all kind of pushed together, create what they call loan origination fees. And they can vary greatly from one lender to another. The great thing is that these days, because we have the ability to share documents and information instantaneously, a consumer can look at exactly what they're getting when they get a certain interest rate. I may have an interest rate of 6.5%, and a competitor may have the same interest rate, but they may have to charge $3,000 to the consumer to arrive at that same interest rate. These are the kinds of things that consumers will be comparing from one lender to another.
And there's a big difference in how that's all changed. When I purchased my first home in 1999, there were no consumer disclosures available. And I ended up finding out after I sold, when my house was under contract to be sold and I was trying to move back to New England, that I had a negative amortization loan.
Whoops.
And that was never disclosed. They never disclosed there was a yield spread premium. Basically, I got screwed and paid a crap ton of fees, and that lender made out like a bandit, made a whole bunch of money. That's why a lot of laws have come into play. So when Ron's working with someone and he goes to quote, he's got to actually produce a document that, and Ron, correct me if I'm wrong on this, that lists all the potential fees. And then they have to break it down now. They've really, I think it was 2017, they changed this where not only you have to break out the fees, but the fees you're allowed to shop for and the fees that you're not allowed to shop for, so that someone can look at a loan and be able to go line by line and say, oh, okay, yeah, no, I understand, because they have to understand what the lender is charging, because it didn't used to be that way. It was pretty deceptive in the past.
Most of which changed with the Thaler-RESPA Combined Act, around 2010, actually. That's called Dodd-Frank. There's a number of laws that really helped us to be more accountable to the consumer, to the point where the laws, some parts of those fees, let's say today's the day, it's 11:30 or whenever, we lock your loan, meaning you and I have agreed that when you get to closing, that rate and fee is exactly what's going to be there at closing. I am required to deliver the loan as promised, particularly lender fees. If I charged you more fees at closing, I couldn't do it. It's against the law. You should, as a consumer, know what you're going to be paying at closing. If I get that wrong, these laws are so strict that in many cases, we, the lender, actually have to cover the difference.
That's good.
Very careful about how our fees are quoted. And there are some fees that can be off within a reasonable tolerance. I won't get too far into it, but our lender fees, if I tell you that I'm going to charge you 6.5%, nothing else, the way to get the rate, and my underwriting fee is $595. If my underwriting fee comes to the table at $1,000, I pay the difference. You, as a consumer, cannot be required to pay those fees above what was locked on the day we locked the loan. There are times when things change, and those are very well tracked by your lender, so that in due diligence, you can always go back and say, hey, the 15th of May, and you locked my loan at this limit. This is the rate, and these were the fees. On the 20th of May, something changed. The lender is required to have an audit trail of any changes made and redisclose those changes to the consumer within a reasonable period of time, so that the consumer is made aware.
So I'm assuming that's the reason why you always hear mortgage officers or loan officers say, we can lock this for 30 days. We can lock this for 45 days. We can lock this for 20 days.
When part of the terms of a loan include the lock period. If I think your house is going to close in 30 days, I'm going to offer you a 30-day interest rate lock. It means that we're going to be there. We're locked. If for some reason that deal goes long, either you're going to, as a consumer, have to pay an extension fee to extend that lock, or we're going to lose the lock and you're going to go to the current market at the time. So very important to understand what the consumer is getting. The loan officer, as Ryan said, should be disclosing the term not only of the loan, but how many days we have in this loan, how many days we have before we have to have closed it within the lock period, because the market can change.
How long does it take you to close a loan?
Ryan and I will probably disagree on this, but I will say, without creating a crazy fire drill on every loan, the standard around most of the country is 30 days is a period in which we contract and underwrite and close. I can certainly do it quicker depending on what level of cooperation the consumer gives. And very often, if I've already fully underwritten the loan, meaning me, but the underwriter we've talked about has already blessed this thing, certainly I can close sooner. There are several processes the consumer needs to be aware of that are going on between the period of time when they get a ratified contract to purchase a home and the day they go to consummate that transaction and close the loan. Those processes do include the lender's underwriting and review of the papers, but there's also title work, meaning a research project from a title agent or attorney, depending on your state, that researches who has owned the property and who has an interest in the property and whether that property will be delivered to the consumer free and clear of surprise liens or defects in the ownership. It's a very important process, and it can only start at the day of the contract signing. So that has to get done between contract and closing. Same thing with an appraisal, which we'll get into. But I can't order, in most cases, an appraisal for a property that we're going to do a loan on until I have a contract between the buyer and seller. And if it's really busy, those appraisers can take 2 days, they can take 30 days, depending on what's going on in the area.
So Ron goes ahead and has a client and gives them a 30-day rate lock, and something goes on, something comes up with title. Most purchase and sale contracts have an automatic 30-day extension built into them. If something comes up with title, you don't need a special permission, no fees to either party. And now all of a sudden it goes beyond the 30 days and Ron says the rate lock period has expired. You can pay to extend the rate lock, or you're basically back in the pool and you're getting a rate at that day. Now, say rates have gone down. And there's the reason why I'm asking this question, because the buyer will think they can just say, well, just let it expire and we'll get this new rate. It's not that simple, is it, Ron?
No, unfortunately, it is not.
You're right.
When
I
a
did miss
lender-
that question.
Yeah, and it sucks for the consumer. But when a lender locks the rate on day one, the rate expires on day 30, either we can relock at the same deal. Most lenders will say, okay, we can relock for another 30 days what you've already been locked into.
For a fee.
Well, usually that would require a fee to extend the investment. Behind the scenes, there are real costs associated with the timeline between when we securitize or lock the loan onto the property and say within 30 days, we're going to have a loan on this property for someone else to invest in. And when that 30 days goes beyond, there's a cost to the lender to wait for the transaction to close. They pass that cost on to the consumer. If the interest rate market is better, unfortunately, the consumer still gets the rate they locked. I'm not aware of a lender who would let them float to market if it improves.
So
Wait,
let me
it's
ask.
worse.
No, wait.
If the
Wait.
interest rate market is worse and the lock is not extended,
They get screwed. Yeah.
they get screwed. They get the
but here's my-
current market, which is
but if
usually
they're-
worse than what they lock.
So
It can. That's
no,
not
and
usually
the
a
reason-
problem, but it can be. It has.
no, but what the reason why I'm asking that question is you can stand on your laurels and you can say to me, hey, Ken, the 30 days passed, interest rates have dropped 1/4 point. We're not going to drop your rate 1/4 point. And I'm going to say, okay, Rocket will.
That's right.
Yeah, but you
Right.
got to start back at square zero. Contracted to close in 2 weeks,
Yeah.
and you think you're going to close in 2 weeks with a new lender.
That's the game, right? To make this a little less complicated for the consumer, the game is all about getting the best deal for the consumer. You just had money that was locked up that you couldn't use for anything else, held for 30 days, and for a reason that was beyond your control, either the house didn't appraise out, or there wasn't a clear deed, or there's a lien, or whatever, you weren't able to put that money into play at the end of the 30 days. So what you're saying is, because we couldn't have this money earning money the last 30 days, in order for this money to be available to you the next 30 days so that you can get all of these issues fixed, right? You're either going to have to pay us a small fee, or we're going to charge a higher interest rate. But what we're not going to do is give you less of an interest rate currently. And me as a consumer,
Terrible, but that is the reality.
right? Yeah. And then me as the consumer, I get to make a choice. I get to decide, am I going to stay with the person that I'm with? Or it was pretty close between Embrace and Rocket and
Guaranteed rate.
I was going to say Citizens Bank. And all of a sudden now I'm wondering why it's worth a phone call for me to call Citizens Bank and Rocket Mortgage and see if they can close. And
Yeah, there's a lot of steps in the background. So all the closing dates, the title work, if you're getting FHA financing and the appraisal is attached to an FHA file number, if the appraisal didn't come in and you have FHA financing, you can't just go to another lender and hope for a better appraisal, because that appraisal is attached to that FHA file number, which folks don't understand. There's just a lot of stuff that goes on in the background. It is unfortunate. Ron had made the statement that there aren't any lenders. And I know there are lenders that have special programs where, especially when times are tight and all the lenders are fighting because there haven't been as many deals over the last couple of years.
Try to do some sort of float because many lenders would rather make half of something than none of nothing.
Exactly.
The general modus operandi of a lender is the loan officer will help you. They place that responsibility on the consumer who signs the rate lock agreement. The consumer should be aware of when the rate lock is going to expire. But the loan officer should be helping you remember that day and offer you for the small fee the privilege of extending the lock. Remember, 50% of the time, market rate is worse. So extending that lock is a better idea, even if you have to pay a small fee to do. The other risk, Ryan, I'll ask you if you're with me on this one. When you switch lenders, in many jurisdictions, the contract can be, you're opening yourself up to risk. Risk that you may not make it to closing on time is clearly the easiest one. And the most important one is risk that you don't show up at settlement on time and risk losing the deposit you gave the seller called the earnest money deposit. Ryan, over to you.
So Ron's 100% right on that. There's always a risk in everything, right? In our job, whether it be Ron as a lender, myself as a realtor, whether you're working in a state that does closings with attorneys or states that do closings with title companies, there's a risk associated with changing because you're now essentially changing the terms of the purchase and sale contract you've signed. Now, I'm not an attorney, so I'm not going to give any legal advice, but you're changing terms. And if you're unable to perform, and I've been through this on both sides of the equation, and typically when it's a happening, because here, Massachusetts and Rhode Island, we are attorney states, so the attorneys handle our closings. They also act as the title agents. The advice we'd generally give our clients if the other party is not performing is we'd just send a very simple message to the other party, says, closing today is Thursday, May 15th. We'll say the closing's supposed to be tomorrow. We'll see you at 10 a.m. tomorrow for our closing as scheduled. You know, at that time, they have now been put on notice that they're not following through on their contractual obligations, and that earnest money, what we call liquidated damages. And so if you don't show up and perform, the seller has the right to keep those deposits as liquidated damages. That's why in that negotiation process, when I'm on a listing side, I want big deposits as much as I can get, because that's doing everything I can to protect my seller client and ensure if something goes wrong, they get a nice chunk of liquidated damages. And if I'm on the buy side, I'm trying to limit my buyer's exposure in case something goes wrong. We haven't run into 2 or 3 cases, and I've been doing this for 17 years now, where we run into challenges with that. It doesn't happen often, but that's generally the hammer that is held over a buyer to perform. If they decide that another lender has a better rate and they want to try and switch, they're making a fundamental change to the terms of the purchase and sale. There are risks that they may not get the same rate, they may not be able to get the same size loan, may not be able to close on time, and they are risking their deposits, and the seller would be able to take those as liquidated damages. And a lot of times the attorneys end up negotiating those damages too, but you're going to lose some money for sure.
This, Ryan, is the earnest money deposit the exclusive remedy?
It depends on the terms of the purchase and sale contract. So in our standard form purchase and sale through the Massachusetts Association of Realtors, which most agents in the Commonwealth of Massachusetts utilize, it's the same in the standard form purchase and sale contract for the state of Rhode Island, that the only remedy they list are liquidated damages. That does not mean that other states don't allow additional damages, but in our standard form contracts, and a lot of attorneys model their purchase and sale contracts off our state association forms, but a lot of them will add addendum or they'll make modifications. And I generally look for that within liquidated damages. If it says, and this is their sole remedy, additional legal terms in equity or whatever, but
So
that's not necessarily the case.
Because I asked this for consumer needs to know in that contract that you're signing with your realtor, in some of the states have been and continue to be licensed in, the loss of your earnest money deposit is not the only risk you take. If the seller can prove other damages in terms of quantifying them and saying, look, we didn't close on time because of the buyer's behavior. I'm going to keep the deposit, but also had another impact on me in that I couldn't purchase my home and I had to pay storage for the movers, and who knows what other damage can be calculated that was done to the seller. In many states, in many contracts within those states, the earnest money deposit is not the exclusive remedy. It is only one portion of what the seller can do to hold the buyer to meeting the terms and performing on the contract. Worst case scenario, I lose my $10,000 deposit. No, it can be a lot worse than that.
It could be. And I want to make sure I clarify something as well that is a super important aspect of this. What we've been talking about between Ron and myself is true as long as the contract specifies that time is of the essence. The state of Connecticut, in their standard form purchase, now I'm not licensed in Connecticut. I have a lot of friends who are licensed in Connecticut. The standard form purchase and sale contract in Connecticut does not include time is of the essence. And if the buyer doesn't perform on time, it's very different. I would never have my client sign a contract that doesn't state time is of the essence. It just says dates and times are important and you're held to those dates and times. Without it, dates and times are merely suggestions.
Kent, generally, as a lender, basically, I'm a party to your transaction in that I am tasked to get you to the closing on time. I use this comedic thing as a part of when I show up at settlement. I walk in like a pizza delivery man and I say, "Who ordered the big bag of money?" You were mentioning the term fiduciary. I have a requirement by the nature of my trade, the ethical standard and the legal standard, is to deliver my solution, my money, in a timely manner. In fact, the consumer is held to the standard using that time is of the essence language in a contract, but I am also responsible to get the consumer there on time. As a consumer, as somebody that wants to use my money, if you want to get a mortgage and you're a consumer, you have to remember that your job becomes being a partner in your own success with your lender. When I am 10 days into your process and I've got your loan approval, subject to certain conditions that have been given to me by the lender, by the underwriter, it'll say, this loan is approved. The underwriter might say, but I need 2 most recent pay stubs to complete my audit file so that I can sell the loan to Fannie Mae, Freddie Mac, whoever is going to invest in it. If you, the consumer, lost your job that day, the condition of the loan isn't met and we may not be at settlement on time. So if you applied for a mortgage, we always say, do your best. Don't change jobs. Don't run out and buy a new car. Wait until your loan closes. So that snapshot in credit time that I have used to propose your loan to the underwriter, that snapshot should be stable. Keep your job, pay your bills on time. Don't run out and run up your credit cards and buy furniture before your home closes, because that can have an adverse impact on your loan approval. And by the way, underwriters not only have the right, but these days are required to verify your employment, usually in 2 to 3 days of settlement. So if you work at a job at General Dynamics, 2 to 3 days before settlement, we're going to contact the human resource department at General Dynamics and say, hey, Ken Thaler is our favorite borrower. He's got a great loan coming to him from us. Thanks a lot for your help. General Dynamics is still working there. And if you're not working there, your loan isn't going to fund. You're not going to reach it.
Very funny you mentioned General Dynamics. That was my last, I was a senior principal engineer at General Dynamics. That was my last W-2 job 17 years ago.
I happen to be a huge fan.
But so the interesting thing he mentions is change of jobs. And what we haven't covered are responsibilities of buyers. Once we enter into a contract to purchase a home, maintaining your job. We've had it before and it happens regularly, even though we tell clients, they'll go, I changed jobs, but it's doing the same thing and it was for more money. Why can't I just be approved? Why is that, Ron?
Let me say this. If you were at General Dynamics as a contract administrator, and then you took a job in the middle of my mortgage process at Lockheed Martin as a contract administrator and you got a raise, that won't, it shouldn't impact you're underwritten.
But
If you were at General Dynamics as a contract administrator and then changed jobs for more money, but actually you're a consultant earning self-employed income on a 1099 basis, underwriting guidelines will kill your loan because self-employed borrowers need to show a 2-year history of being self-employed and having consistent, dependable, and predictable income. It's a very important feature of an income analysis. So you have to be very careful. Generally, the rule is, please don't change jobs in the middle of this 30-day period. Even if you know you've got a new job coming, wait. Till we're done. And I've had it.
So Ronnie, let me see if I to clarify this, because I think that some people might be interested in this. So you can, if you are a gig worker, as long as you can show 2 years of doing the gig work, you've got a shot at getting a mortgage.
Explain what you mean.
Let's say that you were to work for, I don't know,
you drive for Uber.
Yeah, drive for Uber. What you're saying is that because you're a 1099 employee, 2 years of history could get you qualified.
The underwriting standard for a self-employed person is to show a 2-year history of consistent earnings. The most important thing, for example, for an Uber driver is not just what you earn.
It said it's consistent.
It's your expenses. Uber drivers do quite well here. You may have $120,000 a year in Uber receipts. You received $120,000. The average Uber driver spends a lot on their car, gas, tolls, fares, fees to Uber, so that $120,000 earnings gross may have a net after expense of only $50,000. Either way, I need a 24-month average to show what that consistent net earnings is for my calculations that I present to an underwriter. So you have to be very careful about changing jobs. All your loan officers.
But my larger point is that traditional employment isn't the be-all, end-all in getting a mortgage.
That's correct.
That's my point.
Also, and Ryan, I do have programs for 1099 employees that do look exclusively at the gross income. Those programs are not conventional. They are not FHA, and they do tend to have higher risk and therefore come in at higher interest rates. Very often, they will also limit how much you can borrow as a percentage of the value of the home. They call that the loan to value ratio. Most lenders that would do that special loan, a 1099 based loan, will not lend you 95% because their risk is higher. They may only lend you 80%.
To come up with 20% is what you're saying in that particular.
Well, it depends on the loan program, depends on what your income is, what the individual lender's guidelines are. If you're talking to a local bank and they're like, we think this is fantastic. I know this traditional lender said they couldn't do it. We're going to do this as a portfolio loan because we still like it. And portfolio loan means we're never selling this in the secondary market. We will always be your servicer.
And there are great banks that do portfolio loans exclusively. The neat thing about that is, unlike my Fannie Mae and Freddie Mac guidelines, a lending institution, local, for example, community bank, TD Bank as an example, they only portfolio most of their loans. They have lending guidelines and criteria that are up to them, whatever their risk tolerance is. So there's always something out there the consumer can do. The thing I want to represent here is that, remember, the risk is what bases the lender's decision on whether they're going to lend you 100%, 90%. The risk could be your credit score might be higher or lower. That impacts what the lender's going to lend you. You may not have a dime in the bank. We call that you have no reserves after closing. That is a risk to a lender. On the other end, if you have tons of money in the bank and you're borrowing wisely, then you're lower risk to a lender. That's Ryan for pointing out.
And a great example of that is I had a client who grossed over $1 million a year in income, but his credit score was trash because he'd started a company and had used a whole bunch of credit cards and they were all maxed out. So he made over $1 million a year in gross income. The lender was willing to move forward, but he had to put 50% down.
There you go. Perfect example. The risk scales. The higher the risk, something is you've got to give the lender a reason to mitigate that risk. with either a higher investment in the property, meaning a larger down payment, higher credit score, lower credit score, so forth and so on. We even do loans for some folks who want to buy an investment property. We have the ability to lend much like a commercial lender, even on a residential property, based on the debt service coverage ratio, meaning if it's an investment property and you're going to pay $2,000 a month to own the property, but you can charge $4,000 a month in rent, seems like a pretty good ratio. Lender's going to say, that's great. Remember, we're not looking at traditional income, so we'll only lend you 80% on that home, but we don't have to go through the fact that you're a self-employed person and you only report net $20,000. You have enough cash to put 20% down on the house. Debt service coverage ratio works great. Your credit score is strong enough. It's a good loan.
So it's really good. So I'm glad Ron's actually saying the terms, because typically, in the field and lingo, when we're writing an offer and we're presenting it to another agent, we'll just talk about LTV, loan to value, or DSCR. And I know your eyes would have glazed over. But the important part to understand here, what Ron's explaining, and I hope people understand this, because sometimes we can get really wrapped up in the technical side of things, because there's a lot that goes into lending, is that pretty much no matter what your situation is, if you're working with a skilled lender, there is a program that likely meets your needs, whether you are W-2, whether you are 1099, whether you are a W-2 of your own corporation, like I am. There are different programs available, and a skilled lender will understand how to match you up with the right program that will make the best sense and help you achieve that goal. And I just want to go back really quick on the changing jobs thing. I need folks to understand changing jobs isn't the end of the world. If you have an opportunity and it's in doing like the same thing, like if I was still doing engineering work, and at the time I was at General Dynamics as a senior principal engineer, and I had an opportunity at another senior principal engineering job at another firm doing the same type of work for more money, one, I would talk to the lender. And the way we've gotten around that in the past is an offer letter signed by the company on company letterhead that talks about the new income will be in the position. They go, okay, he's doing the same thing. We just need to see 30 days of pay stubs and we'll be able to move forward. Sometimes the lenders, they've gone to whoever they got to go to get approval. But in a situation like that, don't think you can't take an opportunity. Talk to your lender. That relationship with the lender while you're going through it. I always remind my clients, before you do anything, talk to your lender, talk to your lender, not the attorney. Let me know, but the lender is the one that they're ultimately making that decision. Talk to your lender. Right. It's a very important relationship. Don't hide stuff.
Thanks, Ryan. Think of it this way. During the period of time where you've applied for and are hoping for a loan to be approved, your loan officer is a member of your financial family that should be informed of any move you make. And I would much rather, as a loan officer, have a consumer that is nervous and says, I'd really like to go out and get this car, but I'm not sure how getting a new car will impact my loan. I'd rather have that consumer than the consumer who is in the middle of getting their loan approved and is so excited about their new house, they run out and get a Rolls Royce to park in the garage without realizing that doing that may really impact their ability to get the loan approved. Most lenders, by the way, you guys ever heard of credit monitoring?
Yes.
For the consumer, like we as consumers have the right to know who's pulling our credit and all that stuff. Once you have submitted your loan application and you're in the underwriting phase, I don't know of a lender in the United States today who doesn't monitor that credit during the underwriting period. So if a consumer applies for a $500,000 loan with me on Monday, and then 2 weeks into the process, they run out and buy a car and they're increasing their expenses by $400 to $800 a month to make a car payment, the underwriter knows the consumer has gone and applied for additional credit. It's not secret. Everything is monitored.
There are no secrets.
Impact your ability to make the payment going forward.
There are no secrets.
So Ron, I want to ask you this. I know over your career you've dealt with this, and I've dealt with this, and it's funny, and I'd like to hear some stories, because stories are really how people learn.
I got the stories.
Oh, we got the stories. So people will talk about down payment. So I'd like to talk about getting help for deposits from family members. This was one of my favorites, where a father said he was going to help with the down payment and literally showed up with stacks of cash. And the same thing I had at a closing. I don't know why these particular clients thought it was okay, but literally showed up with a briefcase of cash at the closing for their settlement cost. Can you go over what, if that's good or bad, what sort of challenges that brings up, and if you got any good stories to go along with that?
And where do we park the wheelbarrow?
Yeah.
And where to park the wheelbarrow?
Today, in our regulatory world, cash has to be traced. All lending institutions, title companies, and even the real estate agents that you work with, we are all held to a certain and very important regulatory standard. We're required to know the source, maybe not the realtors, I as a lender am required to know the source of any funds used in a real estate transaction for cooperation with the USA Patriot Act and many other federal laws govern and protect our country against the laundering of money that would otherwise be used for nefarious purposes, such as in the drug trade or in funding terrorism. And there was a period of time in our country where many banks were convicted of not carefully monitoring where cash was coming from into real estate transactions. Real estate is a place where money can move quickly in large amounts and be used to wash that money clean. Then the real estate gets sold and the funds are used for God only knows what. So showing up at settlement with a briefcase full of cash is no longer something that is allowed, because it puts the lender and the title company at tremendous risk relative to being complicit in an act of terrorism or other nefarious purposes. We are required to know what funds are being used in a real estate transaction, where those funds are parked before they're used in the real estate transaction, and for how long those funds have existed in a traceable format. Usually these days it's a 60-day standard, meaning if dad's going to help you out and give you $100,000, thanks dad, towards the purchase of your home because he's a lovely dad, I'm going to ask that dad provide me with a bank statement that shows that $100,000 exists on paper somewhere within his financial control, ideally for a period not less than 60 days prior to the use of those funds in a real estate transaction. This process of documentation is known as the gift funding or gift sourcing process in the lending world. And it's very important that we not confuse this gift funding and sourcing with a taxable event for the consumer. They're very different things. It is the consumer's responsibility to report the gifting of money. It has nothing to do with, when I look at it as a lender, I just need to cooperate with the law to know where the money's coming from. I'm not creating a taxable event when I help my kid buy a house as far as the lender is concerned.
Right. You're not reporting that.
No, it's not like
transaction.
Yeah, well, I like this is my own terminology. There is no nexus in terms of reporting between the taxable event that may be and the use of the funds. The purpose of a lender tracing the funds is to cooperate as a responsible lender to know that we as the lender are not complicit in the use of illicit funds. And
You don't want to go to jail, Ron?
I did spend a good amount of time at Sakanawset when I was a kid, but that had nothing to do with this.
Which is really fascinating because when you were a kid, Sakanawset was closed. But that's but that's okay.
It's now with parents and flip me.
Yeah, and mine did as well because we lived maybe a quarter mile from it.
Now it's where some of the nicest restaurants in the state are. What I'm trying to make is the consumer in general, the borrower needs to understand that a lender is held to, I think as a patriotic American, I'm held to a very high standard to participate and prevent the use of illicit funds in real estate transactions. Ryan, I'm sure you're a fan as well. And that is why your lender will always want to know, do you have the money today? Show it to me in a bank statement, a stock, bond, mutual fund. If it's in cash, it's going to have to sit in a bank for a period of time so that I can know that it's funds that I'm allowed to help you use towards the transaction. Buckets of cash raise a lot of questions in real estate transactions. And no consumer should assume that's going to be okay when you go to close.
So I have a slightly tangential question. If somebody's been turned down, how long should they wait before they apply again? Because
Great.
told every time your credit history is pulled, your credit goes down.
Man, I love this line. This question is really important. First of all, when a mortgage lending institution turns down a borrower for whatever reason, either their expense is too high, their credit score is too low, they don't have enough funds to close the transaction, there is no reporting back to credit that there was a deny. That is not a reported function in terms of consumer credit reporting. What is reported to consumer credit is the event that at certain points in time, a mortgage lender did pull your credit. That's it. If we turned you down, we don't turn around and say we turned them down, lower the credit score.
Gotcha.
Okay. That's the first thing I want to put out. The second thing is there is a lot of myth surrounding, if this mortgage guy pulls my credit, my score is going to go down. There's also craziness, in my opinion, out there about soft consumer credit pulls or hard pulls. Listen to me carefully, folks. As an experienced mortgage loan officer who has closed thousands of purchases for families around the country, your mortgage loan officer, who you should credential, you should have a federal license like mine. You should be able to very easily look them up on the NMLS Consumer Access. You should be able to know that your loan officer is legitimate. You have credit scoring so that guys like me and institutions like mine can lend you money. Do not be afraid of a loan officer pulling your credit. You have credit because you are applying to borrow money. It is true that if you have credit pulled by me and then you run out and go to the auto dealer, have the credit pulled there, and then you go to the furniture store and have credit pulled there, and you go out and get a credit card and all these different inquiries on the same day, yeah, your score is going to suffer because you're applying for credit all over the place. But you must take this journey of home ownership by taking the first step, which is having a licensed, qualified loan officer look at your qualifications.
So
apply credit. If you have great credit, be proud of it, and yes, protect it.
So you're able to tell that my credit score has been pulled several times. And that's
on the credit report.
And as long as it's in the, if I'm out shopping for a mortgage and 3 other mortgage companies have pulled my credit, that's very different than if I'm out shopping for a mortgage and 2 car dealerships and 2 credit companies have pulled my credit on the same day.
That is exactly right. Here's the thing. I can't say that it is always in actual practice the case, but I can tell you the law is that if you as a consumer are out shopping for a mortgage and you have 3 or 4 of us pull your credit within, say, 10-day window, that is supposed to count as one inquiry. That also presumes that the credit agency knows that Joe's mortgage shop is properly registered with the credit agency. So there can be some variation there, but you're right.
Hold on. So to people, if you go out and you shop 4 or 5 banks, and then you look at your credit score and you find out that your credit score has gone down just from shopping and you didn't open it and you didn't inquire anywhere else, you should be contacting Experian, TransUnion, or Equifax and say, that's false reporting. It was one transaction.
You can do that. I don't know. Let me say this.
They're very good about responding.
My advice, if you remember my family, and that was how many points did your score fall? Usually the one inquiry is going to affect your score, maybe 5 points. If 3 or 4 people from the same industry vertical pull your credit. If it does, the thing I would advise you is make sure that you get the credit report from that lender, ask them for a copy of it, and look at who was pulling your credit, and make sure that in that process there wasn't an institution that you didn't apply for, because maybe that institution is.
All of those things are discussable with the 3 credit reporting agencies. And I want to state this emphatically. With having no financial arrangements or agreements or anything with them, they're actually pretty good about correcting your report if you can show them that something is wrong. They're timely and they're good at it because they're legal responsibilities that
They're held to a legal standard by the Consumer Credit Reporting Act.
And the second thing is, it doesn't help them any if their information is not believable.
That's right. Couple of things. Don't listen to anyone who demonizes the credit reporting agencies. They do the best they can with the data that they have. Don't expect them to act overnight, because just because you tell them that this inquiry from this institution over here wasn't authorized, they also have a responsibility to research and confirm what you're saying. So it does take a little while to correct things in the consumer credit world and in the credit world. But you are correct. If you cooperate, if you help, if you're a wise consumer, once a year, you can go to, and write this down, folks, annualcreditreport.com. You should go once a year and check it out and make sure you know who is authorized to pull your credit. You did authorize them to do that. I would say one of the great benefits of applying for your mortgage loan is that we, the loan officers, are able to tell you who's been looking at your credit, and you can see whether or not you authorize that. It's a huge opportunity to stamp out identity theft.
In a different podcast that Ryan and I will do at some point in time, when we hope to be able to get a representative from one of the credit agencies online, we'll talk also about credit locks. I have credit locks on myself, my wife, and both of my daughters, meaning that in order to get access to pull their credit report, we have to physically unlock the account for 24 hours.
Correct.
And then we put it back on immediately.
As a loan officer, we we function well with this. This happens all the time. It's not a bad thing. It's a very good thing. In my opinion, I'm like you. I have my credit frozen. No one is allowed to pull an inquiry on me unless I specifically authorize them to do that. And by the way, if you already are with a lending institution, usually that's a default, meaning they're already authorized to a client of theirs. But simply for the loan officer, if your credit is frozen, you should inform the loan officer. You should go and unfreeze your credit for the loan officer. Inform the loan officer that unfreeze window is now open for a 10-hour period of time. The loan officer can retrieve the data, and then automatically the credit will close.
A couple of years ago, my wife and I refinanced this house, and I sat there in the loan officer's office with my phone, and I said, okay, you want to pull the credit? Let's go.
And I think that's smart.
And we did it. And I gave them we basically had a 15-minute window.
That's it. Once you authorize them to do it. I'm going to throw something else out there I think is really important. Listen carefully. When I, as a loan officer, retrieve your credit report, the data in that credit report is personal and private information that I am not legally allowed to share with anyone, as you should expect.
Yep.
However, the credit bureau records the event, that trigger event in time, that I have pulled your credit as a mortgage lender. That event is a valuable little piece of data that most of the credit vendors, the consolidators of credit, sell. They don't sell the data within the report. They sell the event that the report was pulled. So what's happening is that consumer who had me pull their credit, the next hour is bombarded by inbound phone calls, even if they're on the do not call list. Beware. Those people that are calling you, other than the loan officer you authorized to pull your credit, in my opinion, in the opinion of our industry, are violating your personal and private information. No one should know what activity you are performing on your credit other than the person you have authorized. Those things are called trigger leads, and there is legislation pending in Congress.
They can't get rid of those fast enough, but that's a different discussion.
The fact that you are applying for credit, the event itself should be considered as personal and private as the information within the report. And, in my opinion, opens the consumer up to a tremendous risk of identity theft. That event is a personal and is a private event. It's personal information that should not be shared, let alone sold. It's correct.
Yep.
Thank you.
Yeah.
So,
That's fine. Because I 100% agree with you and could easily soapbox that one. We still haven't really gotten to the answer to my question, though.
Okay.
Once you've been turned down, right?
Oh, okay. Yes.
Let me broaden it a little bit. Should you immediately reapply and should you change the type of institutions that you're applying to?
Good question.
Meaning,
let me say this: reapplying will not hurt. The challenge is this: you, as a consumer, when you're turned down from a loan, will be informed that the law If I turn you down, Kent, I have to explain to you why.
Okay.
Listen, there is a reason you were turned down. As a consumer, it's prudent for you to know and learn the reason. If you apply with another institution, that reason will still exist. And if you know that reason, that'll help you determine whether it's time to reapply the next minute, or do I, as the consumer, need to wait a month or two, maybe pay down some credit cards, maybe save up some more cash. Find out from your lender. Not only will they be happy to tell you, they're legally obligated to tell you why they could not extend credit to you. Find out why, and knowing that will guide your decision about whether you could just turn around and apply for another loan.
100,000 years ago, because I'm that old, I purchased a condominium that Ronnie had been to more than a few times. And when I went to the first loan officer, I was turned down, not because I didn't have enough cash in the bank and not because of credit, but it had to do with where the condo was located and the type of organization that I had gone to ask to write that mortgage. And as I was getting really frustrated when the person said to me, they're not going to write it, she then said to me, call so-and-so. Back then it was Pawtucket Credit Union, which is, it's not anymore. And she said, this is the type of loan that they write. And I called
it back into this for a second.
Yep.
So what you did is exactly what Ronnie, the lender, told you to.
Yes.
The bank that you first went to determined that the collateral for the loan in the form of that condominium did not meet their lending standard. There was nothing wrong with you as the consumer in terms of your income, your assets, or your credit as it was represented.
Correct.
On the loan application, it was simply that the collateral, in the case of the it would call a condominium, the term we use is warrantability, meaning will Fannie Mae, Freddie Mac, FHA, will they invest in that loan because the collateral has a feature that maybe the lending standard doesn't like.
Yep.
Your collateral was eligible for financing through the local credit union who makes local decisions. So that's a really great example of a consumer who said, I was turned down over here at big national lending institution who had a great rate. Maybe if I go to the credit union, the rate will probably be similar, maybe a little higher, but either way, I paid the damn loan.
I paid 1/8 of a point more and I got the loan. And what was interesting about it, it was my first time really doing a financial transaction like that. I was 24 at the time. I wasn't dealing, my parents were not involved, although my mother came over the day that I moved in and rearranged things.
Like moving into the dorm room.
It was a real interesting, eye-opening learning experience because I had never had any financial problems. And I felt the bank mortgage person was saying to me, no, I felt like I had done that I was doing something wrong. And the credit union person explained it to me in a way that reassured me. She said, not every peg fits in every hole. And she said, it's our job to figure out which pegs fit in the hole that we supply.
That's right.
And they did. And it was great from my perspective. And I had that condo for 5 years and sold it and then eventually bought this house.
This is an example of what I was saying before. If you're turned down for a loan, be a smart and savvy consumer. Don't get angry. Find out what the reason was. Take ownership of that reason. In your case, Ken, there was absolutely nothing wrong with you as a prospective borrower. In that unique case, and by the way, condominiums can be risky for a lender.
Especially
talk about that if Ryan wants to.
Well, especially, hold on.
Was simply not what that institution wanted. So you went to the credit union. It was what they want.
But more importantly, as a consumer, right? 24-year-old who had never had a car payment because I had always paid cash for cars, right? Who had no student loans because my family was able to afford to write a check for my student loans, and who at the time had any consumer debt that I had, I paid off at the end of the month. It was difficult for me to understand why the bank didn't look at me as a great opportunity And yet credit union did. One of the things that I want people to understand is that circumstances and opportunities are different in all situations. And Ryan and I have talked about this a little bit in the podcast regarding buying a house and selling a house. What's good for you might not be good for Bob down the street. The other example that we like to use is the advice that Uncle Jack gives, because he bought a house in 1965, is only good advice for Uncle Jack when he bought his house in 1965.
Very important point.
And-
Uncle Jack, by the way, is giving you advice, very much like your rabbi, your pastor, your neighbor down the street. They're giving you advice because they care about you and they want you to get the right information.
Yep. And
But make sure you know who's giving you the information, because today, not like in 1960, the ground and the lay of the land and the rules and the regulations and the way banks underwrite loans, very different.
look,
Well,
it's
so
different now.
I will give you a good example. So I've been working with my mother, and we actually had a condominium. I was working with my mother to get a condominium under contract, and there were a number of issues with the condo association, number of issues with reserve funds. But one of the challenges that came to the lending is I have a number of lenders I work with, and one of the lenders, now my mom, of course, had not purchased a house. The last time she purchased a house was 1979. And so she said, I don't understand why this is so difficult. I don't know why they need all this stuff. They required her to take a class on basic finances and budgeting. And it was like 4 hours. And she was so aggravated by the whole, and I don't understand. It's not like I'm a new buyer. It was so much easier the last time I bought a house. And yeah, the process changed. And she was mad at the lender who I've worked with before. I said, it's not a matter of the lender. It's the federal guidelines for whatever the program that's best for you. And it's a requirement, regardless of the fact that my mom was a person who put money in envelopes for budgeting. And when we went to the grocery store as kids, I walked around with a calculator, calculating stuff. But the point is that it changed her perception of what she remembered in 1979 from buying the last house that I grew up in to now, very different. And the expectations are different. And working with a skilled agent and a skilled lending officer and letting my mother know where she was angry with the lending officer. I said, it's not the lending officer. It's the federal guidelines that have changed and the particular program you matched with. It's a requirement of underwriting that this has to be done or you're not going to get approved for the loan. It is what it is. So you just have to take that
Ryan,
4-hour course.
I hope our listeners understand the golden rule. Many parents don't teach the golden rule these days. No one is entitled to borrow money. The real golden rule is that those with the gold make the rules. And I don't mean that to be a wise guy. What I mean is that a lending institution is going to do whatever it can to make less risk in their lending decisions. And if that means I'm going to lend you $300,000, but I'm going to ask you to attend a class for 4 hours in exchange for me lending you $300,000, put it that way, does it really seem like the little bit of time invested in making sure you as a consumer understand the obligation we're putting you on? When I put it to most consumers that way, they're like, oh, this is such a pain in the neck. I'm like, is it a pain in the neck worth $500,000, $300,000 to you? Because if we're going to lend you that $300,000 or $500,000, this is one of the rules that we have. Our rule says that we want to lend to consumers who will be successful homeowners and likely to pay us for the money that we've lent.
I just don't understand why you want to get paid back, but that's a totally different discussion.
Let's not even go there.
Yeah.
But generally,
paid back.
if you step away from all of the terms, the insurance, the DTI, the DSCR, the LTV, put all that stuff away.
That's good because I don't know what any of that meant.
Most consumers don't. Not only don't they know, they don't care, and I'm glad.
Yep.
Boil it down to brass tacks. You are asking a lender, me, to lend you a large sum of money. If I'm going to make a decision to lend you that money, I'm going to set some rules. And those rules, you as a consumer may have bought 10 homes in the past. The rules today say The lender makes the rules. The rules are for even a consumer who has owned a home in the past, under certain circumstances, I as a lender am going to be required to make sure they've completed a home buyers or consumer counseling, home buyers education class. That for the lender is risk management. It means the lender is going to feel comfortable lending you the money because the lender has been able to certify that you as a consumer have been educated on the mortgage process and what is going to be required of you in order to pay money back over time. Not all loans require home buyers education, particularly for first-time home buyers. I require it. I think it's a great idea.
All right. I never took one. Maybe I should have.
I'll send it to you.
I will wait with bated breath.
It's fascinating, scintillating, and exciting.
Yep. Ronnie, we've covered an awful lot today, and I really appreciate, both of us really appreciate your time. As a final takeaway, what's the one thing you wish that every buyer knew going into the mortgage process that would make their lives easier?
Strictly from the loan officer standpoint, I want the consumers in the United States to know your loan officer is normally compensated based on how many loans they make and what the size of those loans are, not on the interest rate or the fees. And the reason I need you to know that is I have to know that the consumer understands I'm not incentivized to raise their rate. Rates are subject to the market forces. My job is to get you to closing on time, and loan officers are compensated usually within 30 days of your closing based on the size of the loan, not based on the rates, points, and the fee. We're actually incentivized to be as competitive as we can on that because we want you to have such a good experience as a consumer that you'll recommend us to everyone else. Ryan had an experience. They tell them something that was untrue to get a higher commission. None of that exists. And if it does exist, it's illegal. Know your loan officer, meet with them in person. Use them if you are comfortable. That is the number one thing I can say. Should make you excited about home ownership. You should start working with your loan officer early and celebrate the process all along the way. Partner with your loan officer to help you get to the closing table on time. And don't forget to invite them to your housewarming party.
Thank you so much for your time, Ronnie.
My pleasure, guys. Great speaking with you. Good to see you.
It was great to see you. It's great seeing you. And we'll talk again as other mortgage issues come up. We'll be doing more podcasts and hopefully we can invite you back and have you on again.
Thanks a lot, guys.
Thanks, Ron.
Thanks, Ron. Bye. That was a lot of fun. Who doesn't feel that they know a lot more about mortgages now that we've listened to that?
Yeah, no, I've been doing this a long time, and my goal is never to assume I know everything. And so my goal in getting into here was to be able to pull a couple of nuggets out here that make me a better realtor and make me a better person to serve my clients and help them with that. And I think for me, I certainly achieved learning a couple of extra things that are going to be vital to my continued success.
From my perspective, I think that the biggest takeaway that I had from talking with Ronnie was the idea that the mortgage officer or the loan officer is part of your team and that he or she is there to facilitate your ability to get financing for what is probably the largest purchase you're going to make until you make another one just like it.
Yeah.
How am I going to afford that house? How am I going to afford that piece of land?
Or even the basic question, how much can I afford?
Or should I be looking in this town or that town or this neighborhood or that neighborhood? Do I need a ranch or a split level or a colonial?
Or I work for myself. Can I get a mortgage?
And all of these things are reasonable questions that I thought Ronnie did a really great job addressing. More importantly, I think that we have a better understanding of how the finance piece fits into the overall real estate puzzle.
Yeah, without diving too much into the weeds, I think we covered it pretty well at a very high level. We could have spent probably hours because there are so many different lending programs out there, whether you're doing conventional financing that can be sold to Fannie and Freddie, whether you're doing different types of loans like a DSCR loan, which we covered. So if you have a dream of becoming a homeowner, which everybody in the country should have that dream of becoming a homeowner, there is a program out there, and finding a good lender who's one, a good listener, two, knowledgeable, and three, is going to be a good financial steward and help you find the right program to get you to that goal of becoming a homeowner. They're a very important part of the process.
Don't think we can emphasize that enough, is the flexibility that the mortgage officer needs to have when dealing with the potential homeowner and getting them into the right piece of property and the right loan. You don't want somebody to be in a property that they can't afford, nor do you want somebody to be in a piece of property that they probably could have done something better if they had wanted to.
And
Right?
I think you learned something really important too today, was that just because you're denied a loan from one lender doesn't mean you shouldn't talk to another, because different lenders have different specialties. And in your case, you were trying to purchase, as a 24-year-old young man, your very first property as a condo, when the first lender you went to denied you. And it was because they really weren't focused on financing condos. But that lending officer you worked with at that time, actually, I didn't talk about it on the podcast, but did a fantastic job of, one, networking and understanding who's a lender who could help you to do that, as opposed to just saying, I'm not going to get paid, screw you, I'm out. They directed you to a financial institution that worked specifically on those types of properties.
When we went to buy this house, I wanted to talk to that lender again, the one who I did first time, and unfortunately they were no longer in the business. And so we used another lender and they were great. And then when I went to refinance, I went back to the original one, or at least I thought I did, but he had retired. And so another one. But the process just, it's so overwhelming. And yet, if you break it up into small pieces and you keep it uncomplicated and you don't fight a battle until you have to fight the battle, you can simplify it. Or, as I like to say, it's not that complicated. And two, you can get what you want, which is the whole point of what you're doing, to get a piece of property.
And it really is a matter of having the right team in place. So between your lender, between your realtor, or if you're in a state that doesn't require licensees to be realtors, just a licensed real estate agent, whether it be a title company or a closing attorney, depending on the state you're in. The folks you surround yourself with in the process really matters. Are they skilled? Do they make things easy? Do they explain things so you understand? Because it can be frustrating. You're going to question things at times. Why do you need this? Why do you need that? Why is this so hard? Why do I have to take this class for some certain programs? And the reality is everyone's trying to help you be successful and move forward and become a property owner. And sometimes unfortunately, there's a little bit of a process to it. A lot of it regulated by the federal government. A lot of regulations have changed even since I first bought my home, my very first property 26 years ago. Understand that everybody has the same goal as you do, and they should be communicating that. And you should be relying on them. When you have a challenge, reach out, and you got a good team member. They're going to explain it to you and why it's necessary. If you can get things to them when they need it, ask questions. Don't be afraid that there's a dumb question or they're going to be angry. Ask the question, because I'll tell you directly as me, we want to make it a great experience for you. We want to make it so that you feel confident in what you're doing, that you have the information you need to make a good decision for you, because it's not about me, not about the lender, it's not about the other parties in there. It's about you as a consumer. And we want to make sure that we're providing fantastic guidance for you, that you feel very confident in moving forward.
I think we've pretty much put the mortgage discussion to bed for today. We reserve the right to bring it out in future podcasts.
And especially when we talk about specific programs, we may have a specific discussion about FHA, which is Federal Housing Administration, VA, Veterans Administration, and all sorts of different programs out there. We even do some stuff on new construction loans, renovation loans. We could talk for hours and hours about lending. We'd probably put people to sleep doing that. However, if we break it up into chunks and they can pick out exactly what they want to listen to, they're going to get an awful lot out of the conversation we're having with these other experts.
Our next podcast is going to be with the president of Bad Elf, an electronics company. They have introduced, or are in the process of introducing, an external GPS receiver for your phone or tablet that allows us to get incredibly accurate measurements as to where you're standing on a property.
Because I get asked all the time when I'm out there with buyers, where's the property line? I've been playing with it for a couple of months now with my clients, and we are able to say with great confidence, and not to replace surveyors by any stretch of the imagination, but for us to be able to, in the field, very quickly assess and understand to a high degree of accuracy where property lines are, where challenges may be. Maybe the property you're looking at, you can't even tell from the plot plan how it's actually laid out. But I've actually taken those plot plans and been able to walk it with the client, and so they can get a better understanding of the type of property that they're actually at and what it means.
Yeah, I'm really excited about this because it's also a chance for us to talk about how technology is going to change or is changing the real estate industry.
This is a next level because all the technology is supposed to make things easier and make a more informed consumer or informed guide, like myself as a realtor or other folks out there in the field with consumers. We want to be able to get you as much information as possible. The consumers are going to want to understand where exactly, to a high degree of accuracy, where property lines are. The agents are going to want to understand whether they're working with buyers or sellers. It really does make a difference, especially when you have a really large property or a funky shaped property or a neighborhood with easements and all sorts of stuff.
You know what?
We can go out there and we can see.
You don't even need that. All you need to know is the playhouse that's in the back of your yard actually in your yard? Is that fence on my property or my neighbor's property? Doesn't matter whether they have 3 acres or if it's 5,000 square feet. All of these are reasonable questions. And prior to the introduction of this device, it would cost you time and hundreds, if not thousands of dollars to figure out the answer to those questions.
Absolutely. Yeah. And time we just don't have, especially in a tight market.
So anyways, till next time, I'm Kent.
And I'm Ryan.
And we are the Real Estate Navigation Team. And thank you for listening to Real Estate. It's not that complicated.
We'll see you next time.